Ladies and gentlemen, welcome to the 25th episode of the Futurum Equities Podcast. I got myself, Shay Boloor. We got Daniel Newman. We got a happy holidays, fun little episode planned today on putting our looking at our crystal ball and predicting what's going to happen in 2026. But before we get into that, how are you doing, Daniel? Is it a chill week for you? I know usually this week is like a type of you can recenter yourself and then figure out what you actually want to do next year, all that. What are you doing on a tight week like this?
It's the holiday edition, but I don't know. I go crazy, Shy, when things are a little bit slower. So, we're wrapping up the year at the firm, Futurum Group, and so, record year, record month, going for finishing out a record quarter. So very exciting times in terms of the business, but of course, things do slow down a bit, meetings, events, travel, and of course, if you're markets, it's low volume days, quiet days, I'd like to see a little more Santa that we're seeing. It seems like Santa's, maybe a little overweight, keeping the sleigh low. It ain't flying so high. I was thinking this week had a great setup. I did say that. It's early. It's not over. We still got today and half a day tomorrow.
Well, I think it's very specific about the setup. I think yesterday was a perfect example of which themes are I got the thumb on it, where AI data centers was huge yesterday. Space names are huge. Quantum names are huge. I think you're seeing a lot of these secular growth themes that have sovereign spend backing it up is kind of catching a lot of the bid right now. Even today, Rock Lab was down 7% pre-market, and they went green. Like the appetite for space, quantum, and AI data centers is just, you can feel it for next year. But again, that's enough of macro talk. We have so many predictions that Daniel and I want to get into. I know
so you want to go like you won, me one, you won, me one.
You go first. I'll give my color on that, and then I'll go give mine, and then you give your color on that. So we do one by one.
I got 8, and I'll publish these, but I want everyone to know that breaking first to this community. So everybody first, I put this list together, and so I'll go with number 1. I'm going to just go down my list. I said, my number 1 is Amazon and Meta will make the full circle and come back into vogue. Those two companies have been relatively crap this year against against big tech, and for different reasons. I know AWS or Amazon is one of your big ideas. I've been skeptical about it because of some of its early decisions in its AI run. It underinvested in infrastructure and NVIDIA, and it paid the price with Google and Microsoft getting ahead. But we saw Project Rainier come up. We've heard and we've seen the work that's being done with Trainium and how that's growing really, really quickly. And of course, I also saw the company make big investments and pour dollars into NVIDIA to make sure that it could solve for both sides of the AI equation for its customers. But remember, this is the largest cloud company by a lot. This has a huge user base, and if it has capacity and if it has the availability of AI compute and AI solutions, like the things it offered this year at AWS reInvent, more tools and solutions and models and Bedrock and everything else that it's doing, I think it's going to see a really good year. And of course, that's not the only thing about Amazon that I like. Amazon's, now got 3-4 major massive businesses. Its ads business very strong. Commerce business continues to be disruptive as well. So I think Amazon's been basically a flat all year, but I think this is one that's set to have a breakout year. And they're one of the companies that's going to benefit more than any in the planet for robotics. So as robotics come online and physical AI comes online, they're going to see their COGS massively impacted in a good way. And that's going to be really good for the business. Because remember, commerce has never really been a great profit generator for the company. Mm-hmm. And this was a double prediction because I said Meta as well. Meta, for a different reason, got hammered this year. It got hammered because it made such big spending commitments and it hired so many people. And then I think people wanted this immediate output of success. Like, oh, Mark, you hired all these people into your AI lab. Why are you not already ahead of OpenAI and Gemini and everything else? Look, Meta is a cash machine. It's got a really solid business underneath it. It's hired some of the best AI talent in the world. I do not believe you can hire these people and within like a month or two have a breakthrough. I think that Mark understands, and he's made the decisions he's had to make around CapEx and spending and investment, and he's all in on the investing. But I also think he's hired the team. I think he's going to get something really special from that team, and I think that's going to happen this year. I think it could be mid-year before it actually happens. But I think all of that investment in talent is going to start to pay off.
I mean, music to my ears. Meta and Amazon's probably the two names I've added the most this year. And I do believe Mag 7 laggers will turn into Mag 7 leaders. But let's start with Amazon because that was actually one of my predictions for 2026. So we are aligned in that right off the gates, which is great. And I think it's the clearest example to me on how a market can misread a slowdown. They think a slowdown is demand driven. So AWS didn't decelerate, like you mentioned, because customers were walking away or AI demand was decelerating from AWS, the king of cloud computing, to the other hyperscalers. It decelerated because there were capacity and power bottlenecks. So if you look at the enterprise commentary over the last year and a half, like projects were not canceled at all. They were just delayed due to availability. That's all it was. And that matters because supply-driven slowdowns reverse very easily if you invest properly. And what we're hearing right now from the AWS team is like they are. And they are fixing their initial mistake. And you're going to see that next year. Trainium 3 is the biggest leap in their custom silicon chip they've had in their history. A lot of people don't realize this, but TPUs, they are actually competitive with NVIDIA right now on the hardware side, not the full system, but just the hardware. That's 7 generations. And TPUs really weren't anything until 3 generations into it. So right now we're at Trainium's 3 generations into it. So if you want to use TPUs as a comp, like this is really where they should be seeing a big jump. And I think that in 2026, multiple things are going to be different for Amazon. First, like I just called out, data center capacity finally comes online. That's going to be huge. Second, power access improves. Third, Trainium 3 is actually going to scale enough to actually matter economically for the business. So when I talk about Trainium 3, though, it's really important the zero-sum mentality cannot be had here. Like what Daniel and I talk about all the time on the pod, zero-sum is the most laziest, idiotic way to approach investing. So Trainium 3 isn't going to beat NVIDIA at performance. It's not meant to, though. That's the important part. It's about lowering the total cost of ownership. That is the name of the game for hyperscalers in 2026. And you're seeing that right now on how that can impact Google with Gemini via TPU. So I think AWS margins will improve while keeping the workloads inside their own ecosystem through Trainium 3. And Amazon doesn't really need customers to abandon NVIDIA to come use Trainium 3. It just needs customers to mix the workloads a bit and stay on AWS. And you're going to start seeing that this year. And you mentioned Amazon's ad business. Like that is probably one of the biggest moats that are just under discussed in the marketplace. Like nobody talks about it. And it's just the second profit engine right now for Amazon that's really scaling up because this is a $65 billion business that's growing 24% top line with 35% margins. So advertising right now is one of the highest margin businesses in the company, and it's growing at 24%. So it's going to continue growing with retail volume. And just this morning, we saw the GDP numbers. It came in significantly above what estimates are, and it's due to consumption from the masses in the U.S. citizens. That's going to benefit Amazon the most out of anyone. So once you see that the retail side of their business is going to be holding up via consumption on the GDP, the advertising business is going to continue being that second profit engine, while AWS still stays in this heavy CapEx mode, which is exactly what you want them to be. So I think that in 2026, you're going to see Meta kind of get re-rated from this business that's going to be like, oh, AI missed them and they open the door for Google Cloud and Azure to scoop up the cloud computing business too. No, we've been the kings we're still the king, and they're going to prove it to you next year on why that is.
All right. Well, you kind of teased it a little bit. So my next one is it's going to be the year of the $1 trillion IPO, but it's not going to be just one. It's going to be 2. But that's not all that surprising. I think a lot of people could predict that because we've already seen some of these eye-watering expectations for numbers. But I am going to make the call that SpaceX will be bigger than OpenAI. And I think, frankly, OpenAI has no moat. I think that SpaceX is truly unique. I have another OpenAI prediction down the line that's actually somewhat bearish about OpenAI. I'll share it later. But again, I think this company has enough name, enough market share, enough dominance to still get to that $1 trillion. I'm expecting they'll close that $750+ billion round here. And I think that SpaceX will take the cake, and it'll be just once again another time that Elon will take Sam to the mat. It's what Elon likes to do. He's just Sam's going to continue to want to dominate the world, and Elon's just going to continue to dominate the world. What's that guy going to be worth? $1 trillion? That should be a prediction too. Will he hit $1 trillion in value?
It's on Polymarket right now. Yeah.
He's on his way. I think that says everything you need to know. But it's just going to be a mega IPO year. So this has been we've been kind of wondering and waiting. I think we're going to see Databricks finally. I know why, you can do a Series L and a series. I think they're going to come out. I think Anthropic will come out. I think they're going to have to. I think they have to do it when OpenAI does it. I just think it's one of those things that's because if OpenAI doesn't, if they do it and OpenAI does it and Anthropic doesn't, and if OpenAI doesn't do well, that's going to crush Anthropic and its investors because they will be nervous after seeing what happens to OpenAI. If OpenAI does well, they'll both do very well. But like I said, and Elon will come out on top, and Sam, once again, will have to accept being a very, very successful second fiddle.
I do agree that Anthropic and OpenAI will be going public together in a matter of 1 or 2 quarters, whenever that happens. I actually don't think Databricks is in any rush. I really think they're going to be delayed a bit, mainly because they don't need to. You're right, Series L can turn to Series T if you wanted to at this point. Anyway, on SpaceX, this is the biggest IPO in stock market history. And I think this is kind of feeding into my second point prediction in 2026 is space becomes investable infrastructure and not just a concept. I think the space economy, ever since the ARK investing days when they released their publication 5 years ago, has been a thing. People have known it's been a $1.8 trillion industry by the end of the next decade or so. But a lot of people still treated it as a toy for the rich, for the billionaires, or just it's more research and development, R&D for science projects, not really anything more than that. And I've been a pretty big advocate since a couple of years ago. I was the space theme is very misunderstood because everyone's viewing this as a science project or some kind of hardware risk that's really difficult to go into the orbit. But there is going to be inevitability especially after AI, that this is the next frontier, especially with the national defense lens and the sovereign spend that's going to come to the space, because governments are not going to be treating space as discretionary spend anymore. It's going to turn to procurement, especially with this administration that we have right now. They are fully aware of the super cycle, multiple super cycle arm races that we have right now in AI, space, and quantum, and electrification. So space economy isn't just about launches, which a lot of people anticipated. It is, or thoughts or assumed. It's about communications, about surveillance, connectivity, logistics. All of that now is going to be budgeted under national security, which makes revenue a lot more durable and less cyclical, which has always been also the bear argument in that space. So when you have the anchor of this huge industry going public in the market at a $1.5 trillion valuation potentially, trading at 65 times 2026 sales. I don't know what their margin profile is, but that is an expensive price to sales multiple. I also think it's a somewhat justified because there's such few winners in this multi-trillion-dollar economy that we know is going to be a permanent shift in society. And I think that it's going to cause a re-rating across the board on a lot of the names in this space. And you're seeing that front ran already before 2026. I mean, Rocket Lab, if it's a high tide raises all boats situation for the space economy, with SpaceX going public 1.5 trillion. Rocket Lab is the second player in that space, and they're emerging as a space prime alternative. And yeah, people might be, oh, well, it's a $30 billion company and they're an alternative. Like that seems pricey if they're trading at 40 times price of sales. Okay, well, they just doubled their backlog on one deal just a couple of days ago. They just landed an $800 million deal with other primes like Lockheed Martin's. Like doesn't matter if they are second fiddle. They're alternative, but that's totally fine because the deal flow in this space is massive. And you just saw an example of that this past week. So I think that Rocket Lab it's my biggest position, my growth portfolio. So I am talking my book. But if you're bullish on the space economy, Rocket Lab is the best pure play in the space right now. The second one I love is AST Space Mobile. They are building a space-based cellular broadband that connects directly to unmodified smartphones. And yes, Starlink is a real thing, but they're totally different business models than what they're trying to accomplish. Oh yeah, a lot the Verizons, AT&Ts, like they don't really want Starlink to win because it's obsolete for them. AST offers that the lifeline of like, oh, we'll build on top of your devices and we'll help you out to compete with Starlink. And I think that's a pretty big picks and shovels of what's going to be coming for connectivity. Then we're seeing Planet Labs also catch a major bid because I think they've transitioned from Earth imagery to like geospatial intelligence. And it's just another example of like these names can continue running because there's only a handful of winners in this space. So I think space is going to continue becoming a major theme in 2026. And when you have the IPO of the stock market history, biggest IPO of stock market history going public, a lot of attention is going to be in this theme. And you're going to see a lot of funds want to get exposure in it. And it's just, there's only so many names that you can actually get exposure. And so I love that theme.
Yeah. If speculation remains high and growth remains strong, space, because again, it's always going to be one of those that's well ahead of its fundamentals. But these are those themes that, people can just absolutely get in. They'll want to front run it because they don't want to wait. They don't want to miss it. There's a lot of FOMO in these names right now for sure. But again, so far, I see you, Shy. I saw you sharing your $3 and $4 Rocket Lab purchases. So your only mistake is you should have bought more.
Listen, you went on national TV when NVIDIA was like at $15 and Broadcom was at way lower. So like you got the clout. I need to get some space clout.
I make some calls. You make some calls. But sometimes again, you've actually put your money down on some of these too, which is really, really great. So here's my third one, and I'm not a Bitcoin bro, and I'm not a crypto bro. I have about 2 to 3% of my net worth in crypto, and only really in 3 token. I have it in Bitcoin, I have it in Ethereum, I have it in Solana. But I do think that next year will be the year you get the rip. And here's why I think this. I think this year was a year about institutionalizing the assets. I think, seeing, BlackRock and Vanguard and Fidelity, I think there was a little bit of, institutional positioning that was going on throughout this year. And, getting in at all-time highs makes less sense than getting in at, 40% below all-time highs for these assets. But I also think this is a really pro-crypto administration. You've got really pro-crypto legislation. You got pro-crypto policy. And it really hasn't paid off since Trump entered office. I think everybody thought it was going to be an immediate rocket. There was that kind of rip upwards. But I think next year is going to be a really, really good year. There may be a little bit more downward pressure first. But again, people that have been around these assets for a long time have to understand that this is how this works. It is not one of those things that's slow and steady and up and up and up. If you want to do that, buy gold or heck, even buy silver these days. But if you want something that, has exponential potential, that's sitting in a very positive policy posture right now, and you still believe in the asset, it seems like now is a much better entry point than it was when Ethereum was trading at 4,000 plus, and when Bitcoin was at all-time highs, closer to 130. And Solana. And those are the 3 I really like. I think they're going to do well. Having said that, I do think the bifurcation and the sort of separation with a lot of what I would call the shit coins and altcoins, I think that's going to continue to dwindle. I think a lot of the pipe dreams of of getting rich buying, 70 million of some unknown coin that's going to get a weird Elon level pop when, he doges it. I think those days are coming to an end. I think as crypto gets institutionalized, the fringes will start to evaporate, and a lot of them will become like micro cap stocks and companies that just go nowhere for a long, long time. Mm-hmm. And so, my recommendation, not financial advice, of course, though, is positioning into the best assets and the best asset classes with the most liquidity and the most demand. But I do think if you're in those assets, there's a lot of upside.
No, I mean, I agree with that sentiment of altcoin. It's also a very good thing for altcoin not to be a real thing. But
it just chews up liquidity. It chews up liquidity that could be going into better assets.
There's only so much pie that can be eaten. But yeah, I mean, to add some color to what you're saying, like I'm a big Ethereum bull for 2026. I've been building a position, BitMine, as my vessel for that. And the reason I'm bullish on this specific flywheel is that I think that you're seeing signs already this year that Wall Street is moving onto public blockchains. And Ethereum has kind of been that venue that they will actually build on. So when I say that, I'm talking like zero downtime, smart contracts that enterprise will continue to standardize on, and stablecoin rail that already clears hundreds of billions of dollars and is aligned with U.S. policy and an administration that's very pro that, because stablecoins in a way recycle into treasuries. So if tokenization and stablecoins are actually going to become the next on-chain operating system for finance, which I do start to believe that might be the case. Like then the scarce asset is Ethereum. And I think that if this was ever going to happen, this is the administration to push that. And there's a reason, like you're seeing figures like Tom Lee, Peter Thiel, Kathy Wood, like they're all loaded in. And I think that BitMine is playing like the current meta where you use public equity as a war chest. You raise faster than you spend it, and you stack Ethereum kind of while the market sleeps on how quickly stablecoins are becoming, and stablecoins and programmable finance becomes more embedded into real infrastructure. It's not going to be clean. It's not going to be elegant, but I do think there's a theme here. And I think that I built a decent position in my growth portfolio to capitalize on it. My third one, let's see my third point for 2026. Oh, I think the AI economics flips next year. And I think that distribution matters more than model quality. And you're going to see that continuing next year. And what I mean by that is I think model quality converges faster than people expect. Like I think you're seeing good improvements, but not as the velocity isn't there anymore. And it's due to a lot of factors that are just like, we can't improve model to model as much as we were able to a year, 2 years ago. GPT-4 and 5 is a perfect example of that. Gemini 3 was really the biggest leap they've had in model to model in quite a while. And there's so many different AI labs that are trying to tackle this. And Gemini was the only one who was able to do so. But I do believe that the interface inference cost falls way faster than people expect as well. So when that happens, when model quality converges and inference expenses fall, what happens then? Models stop being the profit center, but whoever owns the interface becomes the toll booth for it. So I'm talking about that. It's these ecosystems like the Amazons, Metas, Googles, like if you have search, social feeds, like messaging apps, like operating, like all these different network effects, ecosystem that are just surfaces where AI shows up. Like those are the companies who are going to be able to control and become that AI toll booth when you don't have to sell AI as a separate product. They just use it as a tool to increase engagement and retention, like monetization. So like I think that platform companies outperform in the next phase. I think not because they have the best models, like they don't need to. Again, like Gemini Gemini ended up being the best model, but they don't have to be the best model because the ability to monetize behavior at scale is going to be everything in the next phase of AI. So I think distribution becomes a moat once intelligence becomes cheaper and cheaper. And that's the signs that I'm seeing signs of that. That's why I've been building up in Meta, Amazon, and Mercado Libre have been my three names I've added the most this year because that's my thesis for 2026.
The marketplace play.
Yeah. We'll see how it goes.
I definitely believe in model diversity, and I definitely believe in different models for different purposes. And the best platforms and tools will use a lot of different models. They're not going to be kind of sole dependent. I also have said this, it's not really it's more my 25 call, but that LLMs are they're the parlor trick of AI. They are just the wag the dog, look here, this is something neat. The big stuff is still coming. So my fourth prediction is energy goes vertical as AI explodes. So what we saw yesterday, the Intersect Power deal, $4.5 billion from Google. This year, we saw a lot of interesting energy plays. We saw a lot of, I call them GP REITs being formed. These were mostly Bitcoin miners that had energy and capacity, and they started turning it around for high performance compute. That's still a thing, and it's going to continue to do well. I think all of the Nebius CoreWeave capacity continues to get gobbled up. I think the Ciphers and Irons continue to be strong deal makers, and they will continue to offer expanded capacity to different cloud providers. But I actually think you'll see things like battery storage investments. You'll see, I spent a lot of time last week talking about the fusion deal with TAE and the Trump Technology Group. I think we're going to hear and see more of this. We're going to see dollars being piled in from hyperscalers into these kinds of investments. So meaning some of it will be on the venture side for longer term build outs like fusion. I think you will see more deals to try to bring fission and kind of near-term nuclear power. I would think we'll see more kind of solar and battery and energy capacity and storage deals. But you will see Google's and Microsoft's and Amazon's saying, we don't just want to rent excess capacity. We need to think long-term, and we need to think about where do we get ownership of excess capacity? How do we take advantage of going fully vertical? Historically in technology, vertical was really chips to application. Now I think we're going to see a change in 2026 that it's going to be power to application. And that's going to be dictated by the demand for AI.
I couldn't agree more. I think the real winners of this next phase of AI are also going to be kind of the landlords who control the power, land, and interconnection. And I think that you're seeing hyperscalers kind of don't want optionality anymore. They want guaranteed megawatts because they just need the tools necessary to fulfill the AI demand. So I think power becomes a gating factor for AI revenue. That's as clean as I can say it. So yeah, I couldn't agree more. And I think that's why the AI utility theme has like legs still. Like I don't think it's a local top in this cycle. A lot of people call that Iron, Cipher, CoreWeave, Wolf, Nebius, like these names are never going to see the previous all-time highs again. Like I'm like, okay, we have not even hit the power constraint issue. Like AI demand has not hit its wall against the grid issue yet. It's getting there, but it's not there yet. So yeah, you're calling this theme way too early. Next, my next point I want to talk about for 2026 is I think emerging markets will significantly outperform the S&P 500 next year. And I think that when I say emerging markets, I'm talking Latin America, I'm talking Southeast Asia, I'm talking potentially Europe, but who knows, because they don't care about GDP growth. So maybe Europe doesn't belong in this. But I think that in past cycles, emerging markets outperformance depended on a lot of things that are on the macro front, like commodities, currency movements, or some kind of global stimulus. When I reference that emerging markets will outperform S&P 500, I'm actually talking about something else. I'm talking about the explosion of digital products that are going to come from AI tools becoming cheaper and cheaper. Intelligence is going to continue to become cheaper and cheaper. That's going to feed into so many different distribution networks. And this is a 0.3 for me, but it's kind of, 0.4 for me, but it kind of feeds onto my 0.3 of like distribution is going to be the biggest moat. But I think that the AI tools, the cloud infrastructure, like all these mobile first adoption that you're seeing, especially in Latin America, it's going to allow these like companies and emerging markets to scale without the decades of legacy systems that's kind of anchor them down a bit that the US didn't have to go through. So I think they're now replacing old infrastructure. Like in the cloud era, like it took a while for these emerging markets to really benefit from it because they had to replace a lot of old infrastructure, and that takes time. I think AI is really interesting because you don't have to go through that onboarding issue of getting new infrastructure. You skip it entirely. So Mercado Libre, I'm talking about this already. It's my favorite name for 2026. Like, it's the cleanest example of this because you're seeing digital payments balloon up in Latin America. You're seeing e-commerce, logistics, the credit all are all scaling at once at the same time. I think that when those layers grow together, you get operating leverage, and then especially when AI tools become margin expansion opportunity, and also provides an explosion of digital products that are going to be put into your marketplace. There's just so many tailwinds. So I think that emerging markets will outperform US growth, but also I have to talk about the macro color on that prediction, because a weaker dollar and lower US rates matter for emerging markets. Like, I'm saying, like, that's not the only reason I'm bullish on the space is because it's a digital product explosion, but like, that matters a lot still for this theme. And I think declining dollar improves capital flows into these emerging markets. I think it eases funding pressures. I think that it makes EM earnings translate more favorably back into the dollar. So you can see a lot of like favorable earnings reports every cycle. So I think it's a really big tailwind. And I think so. The two things on emerging markets to be a really good theme in 2026 is AI will create digital product explosion. We're going to be cutting rates next year, and that's going to cause a weaker US dollar. So it's kind of a twofold tailwind right now in that space.
Yeah, totally in line with this one. I know we've got 20 minutes, so I want to make sure. I don't know how many more you have, Shy.
Let's see which one I have. I have
8.
I have one more, so maybe you do two in a row.
Okay. Yeah. Sorry. All right, I'll give 2. This one's for all the Apple fans out there. I'm a bit of an Apple antagonist at times, but I do think this is the year Apple makes a return to AI. It took off most of 25 and all of 24 as well. Apple Intelligence was a total flop. It's underinvested significantly in any sort of infrastructure. Now, again, its cloud is not the same as like hyperscalers, where it has to have enough capacity to support enterprises that are running its platform. But people look at the Apple ecosystem, and to your point about marketplaces, is one of the critical, places in which they consume applications and tools and capabilities. And Apple's just sort of sat this one out. They've partnered. They've done some stuff with OpenAI. They've done some stuff with Google. But what is Apple's real AI strategy and AI plan? It's sort of still an unknown. They've had a leaky bucket of talent that have been flocking. So every time they name a new person to lead their AI, weeks later they leave to go to Meta or they go somewhere else. We've heard, this might be the Tim Cook's sort of twilight here. He's getting long in the tooth. He's been there a long time. He's certainly managed the business well. He's brought it to, some incredible highs in terms of valuations, but really not on the back of any real big breakthrough innovations, not really from phones and PCs or laptops or MacBooks or whatever we want to call them, not from iPads, not from new platforms, new formats. He's just incrementally brought the business along. He's done service as well. He's done, he's done iterative models of phones well. He's brought new features, and he's kept the brand strong, which has worked. But I think they're going to have a play in AI. So I think we may see the Cook transition begin in a big way in 26. They're going to see a changing in the guard, though, in my opinion. They're going to have to start investing in CapEx. I don't think it's going to be with NVIDIA. I think it's going to be their own chip. I think Apple has a very sort of all about Apple approach. So if it can avoid, from an infrastructure standpoint, becoming dependent on anyone else's, I think that's the route they're going to go. Of course, like I said, they have partnered a little bit in AI, which is pretty non-traditional of them to do, but it was also indicative of how poorly they were doing on their own with their own AI strategy. But here's the thing about Apple for everybody out there is Apple doesn't have to be first to win. Apple is not really the most innovative in almost any area. It's just the best at telling the story of innovation, and it's the best at winning the user experience, and it's always been the best. So given its huge install base, its huge user community, its passionate investors and passionate Apple fans, if they can come out with something good, if Apple Intelligence and what has been long known as Siri, which is a total pile of crap, if they can make something good of it, I think they can win a lot of users, and kind of what we're seeing with Google and how successful and quick it's been able to spin up its success story based on its user base. Apple has a play to be made. I think 26 is the year we see it. What do you think? I got one. I'll do one more, but any comments on that one?
I think the reason Apple is trading at 40 times earnings or 35 times earnings is because that distribution mode. Nobody can tackle that ecosystem. So my only concern is what you just highlighted. Like you need AI brains to become a winner in the AI economy, and they don't have any right now. Everyone's leaving. So like I think at a certain point, like you have to stop relying on this massive ecosystem mode that you actually do own, because eventually the way capitalism works erodes over time if you don't do anything to get in front of the next great thing. And I think maybe, who knows, like there might be a competitor down the line and all of a sudden they have to actually participate and it might be too late for them. But I don't think we're there yet, but I think that eventually like, they have to, like, someone has to light a fire under their tushies, and maybe the next Tim Cook will do that for them.
Yeah. So quickly, I'll hit my next one. You sort of, I sort of tease this. You sort of teased this with your prediction about model costs collapsing. But mine is the enterprise AI. 2 words, like the AI doubters, the AI skeptics have obsessed about monetization. They've basically said that AI's monetization is the TAM that is equivalent to people's subscriptions to ChatGPT, Anthropic, and Gemini. And that's just totally wrong. I shared this yesterday, but I don't know if you know this, but Gemini right now, just Gemini it's like 10 trillion tokens a day, just in Gemini.
Wow.
And so when you look at that size of volume and you start applying this over businesses, I think what you're going to see is that the business use of AI is when the inflection to revenue takes place. And this isn't something like the internet that's going to take 5 or 10 years. This is going to really start to take scale this year. We will see the renaissance of, so the renaissance of enterprise. We will see hyperscalers growing because of this. But I also think some of the software companies, Palantir, will keep ripping. And despite people's obsession that it's overpriced, I think it will continue to grow into its price. I think ServiceNow, which by the way made another deal today, announced another deal this morning. I don't know if you saw that. ServiceNow will do well. Salesforce, despite the fact that, there was some concerns about Salesforce, I also still like IBM very much. IBM still an enterprise software play that's really taking a very different approach than the other hyperscaler / cloud provider / enterprise companies. But I think you're going to see a lot of acceleration in revenue. That's because 2 things. I say enterprise workflows and agents. Enterprise workflows and agents require trillions and trillions and trillions of tokens. So you put this together and you say, this is where people can afford to pay for AI because it makes businesses more productive and more efficient. So I think 2026 is the year enterprise AI and AI revenue for enterprises starts to be a much bigger part of the equation as opposed to just LLMs.
No, I mean, less than 1% of AI is being used in enterprises. It's got a long runway. I just think that my 2 cents on that, I really don't think enterprise software is going to catch the bid it deserves until we stop being compute constrained. I think all the eggs are going towards that basket, and it's just anchoring a bit the enterprise angle. But that's, who knows when that moment's going to last. So I'll let you go on to your next one. So I want to do Q&A for next. Before Daniel says his last one, we're going to do Q&A in 5 minutes. So put your questions down and we'll answer as many as we can for the last 10 minutes.
Okay. So you want me to hit my last? I actually have 2 because I had 8. So I'll hit them really quickly so that we can get through these. We just have too much to say. So I said earlier, my first one, I said that, about the $2 trillion IPOs and OpenAI. I think OpenAI falls to 3rd in the model game this year. I think, I do. I think Google's going to jump ahead of it across the kind of language and enterprise. And here's a bit of my surprise one though, is I see Grok as a, on the code side. So Grok and Anthropic have been really basically eating up all the code. Anthropic's built a great business model there, but you've seen just some of the data that's come out about using Grok for code and some of the new work that they've come out with. And I just think that, basically you've got Google, you've got Anthropic, and now you've got Grok all really sending some jeers up the spine of Mr. Altman. And like I said before, I think it's personal for Elon. I think he's leaning hard into it right now, and I think it's starting to pay off. And my last one, and this is a quick one, is there will be no unseating of NVIDIA as the king. I think there's going to be a $300 billion revenue year. I think it's going to continue to win data centers. I think China's back in play. I think that was basically a $0 call option for a lot of the investors. And I think, I said it this way. I put it in my note. I said a little bit like when New England Patriots were winning every single year, a lot of people started to root against them. A lot of people started to root against Tom Brady. But Tom Brady's still the GOAT, and New England was still the best team in football for a very, very long time. And while I do believe there's other options, I do believe that others can do well because it's not zero sum. NVIDIA is just so dominant, and I don't see that happening. There are no warehouses full of GPUs or rack scale systems out there. Sorry, Michael Burry. It's just not a thing. And I think NVIDIA will come out next year, and it will not only be the king, it will be the biggest profit generator. It will actually pass up Google, and everybody knows I'm a big Google fan. So it's going to have a big year.
I love it. I still think NVIDIA will be the first $10 trillion company in the world. So we'll get more momentum on that. But I also think it's funny because it's the same mentality that a lot of people thought the Mag 7 names would be duds for the past 5-7 years, like opportunity costs, like they've ran up so much, like they're not going to do well, etc. When you're a winner and you keep winning, people love to call a top to something. It's the craziest concept, but I think you're going to see the same thing with NVIDIA probably continuing, and they're going to be proven that was a mistake. All right, so let's go over questions, Q&As. I see a couple great ones. Taylor, can you bring up the one that's Freeze 1988? It's about inference costs. I think that's a really important one because that's going to be the other one. Sorry, it's about if we expect inference costs to come down rapidly. Right there, 8:03 a.m. was the comments. 8:03, no, above. Perfect. All right. If we expect inference costs to come down rapidly, then what does that mean for the likes of neoclouds, energy stocks? Is this as high as it gets, the local top, and is it a good time to exit? I think this is a great question because this has been asked to me repeatedly in my subscriber group. So my takeaway, I'll let Daniel have his input on this as well afterwards, is I don't think inference costs coming down will kill demand. It actually usually explodes it. We've seen this pattern over and over again in cloud computing. The cheaper the computing becomes doesn't necessarily mean less spend. It actually means more use cases. It means more workloads. It means more total volume. So the unit price goes down, but the surface area of demand actually expands much faster. It's been the case for any type of revolution we've experienced. Neocloud specifically, we can get into this. Like the problem for them today, the CoreWeaves, Nebulouses out there, isn't the demand. It's actually the margin structure and access. Like if they can offer competitive inference at lower costs per token while still earning a spread, they kind of become this more viable as overflow and specialty providers for workloads that hyperscalers can't really do themselves or prioritize. So like that is more the key variable, not whether inference is cheaper. It's just who controls the capacity, the power, and the customer relationships. That's essentially like one of the points that Daniel was talking about. On the energy and power, like I think the idea that lower inference cost reduces energy demand is kind of one of the bigger misconceptions of the market. I think if models get cheaper to run, they get embedded everywhere. So that means more queries, more agents, more inference. Like all that means to me that total energy consumption goes up, not down, because usage usually scales faster than efficiency gains. So any color that you want to add to that question, Daniel?
Yeah, I mean, I think this is the Jevons paradox is the answer here. This is, remember, the DeepSeek moment, and bringing, test time compute would crush demand, and basically new techniques with models that created more efficient models that needed less compute, created more use. You still see every different company is lacking compute. We're still super constrained there. And you heard my number about the 10 trillion tokens a day, and this is just getting started. This is without like any real heavy utilization. I use the Salesforce 3.2 trillion tokens for Agentforce with less than like 1% penetration into its customer base so far. So in all these use cases in enterprise and in life, just when you see these things being ticking up for more video, more image generation, more, of course, language, and then of course you have industry models for healthcare and for legal and for financial services. That what you're going to do is you're going to throw more data at it. You're going to do more things with the tool once it works and once it becomes more cost efficient and more energy efficient. So we're not even close to touching the edge limits of usability. And so every new generation is going to be orders of magnitude more efficient. We know that, but the use and scale of use will happen much faster. So I am not worried about it. I actually think bringing it down is what's going to bring those revenue models and those larger monetization opportunities out.
It's like, if gas becomes cheaper, you think there's going to be less cars on the road? No, there's going to be more cars on the road. Going from point A to point B becomes much more economically feasible. That's kind of how I think about inference costs going lower for the energy and neocloud theme. Next question. I get this one a lot. We can go the one right underneath this. It's about Redwire. Perfect. So I get this question a lot because I'm the space bro on FinTwit. Early Rocket Lab and ASTS, and I don't own Redwire. I used to own Redwire. What happened? I don't trust their management at all. And I'll tell you why that is. If you don't know, like, small cap investing is difficult. A lot of people anticipate it's actually a lot easier than it is. It's very difficult. It's like watching your house catch on fire, and the only way to survive that house fire is if you trust the person guiding you to that front door. So when that trust is gone, you burn with the house. What happened at Redwire? I think it was Q2. I don't remember specifically. It was earlier this year. I no longer trust the person at the helm because they had one of the worst earnings reports I've seen in quite a while. I forgot what the exact numbers were, but I remember it being like 30% miss on revenue. I think they went from like a EBITDA profitable to all of a sudden like a $30 million loss. I think they just, like, everything was a complete opposite of what the anticipations were for that print. And I get it. Small cap investing, like, it happens every once in a while. That's not the reason I lost trust. It was, they didn't pre-announce when you know the numbers are going to be that much of a miss, and not just like 10%, 5 to 10%. It's a complete 180. You pre-announce. That's just how you do. Like, you have to pre-announce because something structurally changed where the expectations are just like in a different universe. So that's like part A. Part B is days before they reported their earnings, their CEO was on TV hyping up, I think it was a Space MD commercialization strategy, and just talking about all this, that medicine in space is going to be like a major talent for the company, knowing full well that they were about to report one of the worst quarters in company's history. So A, they didn't pre-announce, and B, they doubled down and went on national TV to hype up the stock on something that was a story-driven narrative, not anything about the earnings. I was like, how do I trust you anymore? Especially when small cap investing is like your house is on fire. I don't trust you to guide me out of this house anymore. So because of that, this could be a great company down the line. I think space economy is so juicy and there's so few players that a lot of the names will just high tide resolve boats. But for generational wealth, generational compounding, I just don't see it because I don't trust the management. And that's the reason. I could be wrong, but I don't know. I know you talk a lot of CEOs out there. Like,
I had nothing on space, but what I would say is, there is a lot of value in picking management that you trust. And, I've been through this with SoFi this year. Everyone knows I'm a big SoFi bull, but I do believe in Anthony Noto. I don't always believe he's the best, like, kind of retail guy. He doesn't do the things that I wish some of them would. But in terms of like making good decisions. So when he would dilute, for instance, when you have someone that's brought the stock, by the way, beating and raising consistently quarter after quarter after quarter, delivering every quarter, and says, hey, we want to raise money. And by the way, not going to maybe tell you exactly what we're going to do with it and why. You have that, like, hey, do I trust or do I not trust? Because that's really the question at that point when those kinds of things happen and it causes some negative momentum in a stock, is like, do I still trust? because that's it. As individual investors in these companies, we don't have any control. So if you can't look at the management and say, I trust the management, then, that's like the one thing you really have some say over, is picking companies with management that have given you, a reason to believe. And, I say the number one is generally going to be delivering on a quarter over quarter. Like, can they beat raise? Do they understand to kind of how do they handle the Q&As? 3, I sometimes look at like, what is their individual, like how often are they selling their own stock? I don't have a never sell. I think that's BS. I think these guys people have to be able to make some money and be able to take some chips down. But I don't like the ones that are always selling. And then the fourth one is, kind of yours, like, just, do you get a good vibe of ethical and sort of what they stand for? And so, yeah, I think you're making the right point. I don't know anything about that company though, so can't.
No, I mean, no, I'm glad you said that, because I wanted you to respond with something more applicable across different industries. I mean, listen, at the end of the day, a company is just a ticker with a narrative. So if you don't believe whoever's saying the narrative anymore, you can't participate. I mean, I think Vlad is probably one of the best case studies on how you can lose trust and how you build it back up. It took him years. So I think that it's really important. Let's go to the next one. Let's go to Lee Bailey. I think I'm trying to go to one per person.
Yeah.
Emerging markets.
And just so you know, I probably have to drop after this one. So if you want to hang out a little bit and take a few extras, but I've got to get on a client call. So it's people all want you anyway.
The real biz.
I got a little bit of real biz to do.
Okay. All right. So emerging markets, would you recommend Nubank, C Limited, Pinduoduo, Coupang, Alibaba? I'll let you answer first before you hop off. Like, do you have any kind of thoughts?
Yeah, my gut is Nubank, because I've watched it closely, and I kind of look at it as like the SoFi of South America. A lot of similarities. It's not run away just yet in terms of its price. I have not deeply studied it, but I would say I like it. All the China stocks, I just worry. There's so much geopolitical. There's so much kind of nonsense. It looked like there was a period where Alibaba was going to kind of break out, and it did for a while. But it's just like, it feels like there's just so much outside of our control when it comes to these names, and they just all make me nervous. So I'm leaning to Nubank.
Okay, awesome.
What about you?
Any final? I'm leaning. So I'll get into it real. You can put that back up, Taylor. I'm going to go into these names, but I think you can't trust the Chinese economy. I mean, not Chinese leadership with Alibaba, like Pinduoduo. You just never know. Nubank, I'll get into that later. But like, why bother if I'm bullish on Mercado Libre? It's the same theme. I'm doubling down. But any final words you have before hopping off? Before I continue answering this question?
No. I'm gonna post my my extended. I'll put it up on X. I'll have Shy retweet it so people actually see it. I'm kidding, but Shy's the man. Do appreciate everybody being part. We are going to really commit to this over here on YouTube. We'll still be inflammatory and active all day on X, like we always are. But we do definitely want. I think our big goal, our prediction, is that the Futurum Equities takes over YouTube next year, and this is going to be a big platform for us. Hopefully, as big as X or even bigger. But thanks everybody for spending time with us, believing in us. For those I'm just meeting, it's great to meet you, and let's stay in touch. Happy New Year.
Awesome.
Merry Christmas if you celebrate. Happy holidays, and Happy New Year.
Awesome. Well, talk to you next year, Daniel.
All right, man. Finish up. Take care of everybody.
I will. So so listen, you guys heard my thoughts about Pinduoduo, Alibaba. I think for Coupang, they have a new CEO. So I think the new CEO, I think he resigned because of some kind of data hack. I don't know specifics about that, but that's not a good sign. Again, trust on consumers is a fickle thing. So I think that Southeast Asia, like a lot of these names that you brought up, like they're all kind of fighting each other in a part of the world where it's hyper competitive. Nubank is one name I want to really get into because it has everything I would want in a growth investments, and I've never owned it. And I really do believe it's like the reason for that is less about Nubank. It's more about Mercado Libre, like I mentioned before Dano hopped off. But I don't think there's anything wrong with Nubank. Like I remember in the recent prints, I was incredibly like whoa about their Mexico story. I think that story is really specifically interesting because I think as a couple years ago, their customer base was like super small, and I think that I was tracking this name as my watch list because I was just 2 years ago it was a much lower, smaller valuation, and I was like, whoa, like this could be a growth story. I've never seen numbers like this on a fintech side, and I think today, 2 years later, they've like done something like double the number of cards in circulation. I think that they're already capturing, I want to say it's, don't quote me on this, like 10% of the adult population. And if that trajectory continues, Mexico could mirror their Brazil playbook that they had for the next like 5 years, and that would be their growth engine. So add Colombia and then add Argentina, which I'm super bullish in the Argentinian region going forward. So like I think this is a few companies kind of ever prove product market fit across more than one large emerging market, let alone 3 or 4. So like I do like Nubank. It's just the question I have to ask myself like is whether or not I treat Nubank like a cyclical regional bank that happens to be growing faster than expected, or a foundational consumer fintech platform in Latin America. I think they're, let me look up their multiple right now. Their multiple is, let's see, 19 times earnings, 4 times price to sales. It's not expensive in any means. It's just, I personally think it does probably deserve more respect than what the market's giving it. But Mercado Libre just has a network effects of commerce, logistics, and payments all feeding into one another. And I think that integration, like if you got a theme from this whole episode, is like, I think an ecosystem and distribution is going to be huge, and it's going to make harder. It's going to make it harder for platforms to get disrupted. So I do think Nubank will almost certainly be much larger 5 years from now. I actually do believe that because I'm super bullish in the emerging markets theme, especially in Latin America. I just think that if Mercado Libre is a top 3 position for me already, like it feels duplicative to kind of own this and Nubank, if that makes sense. Let's see for next one. Aloha 985 is the next one. And I think that I'm trying to look at what EOS's energy is doing this morning. Let's see. Yeah, I mean, I think EOS energy, I don't know why it's fading 7% today. Maybe it's technical. Maybe it's, you know, what's really interesting, actually, it is, this looks like a technical bounce on EOS energy. So the reason I say this is there's been an anchored edge of VWAP. If you guys know technicals, going back to the July 14th, 2025 breakout, has been the level every time the stocks pull back, it bounced. You look at November 20th, 2025, it bounced perfectly off there, and it's kind of sitting at the exact same point right now. So I think that's an interesting bounce spot. But if you don't know EOS energy, it is my favorite way to kind of play the AI power grid issue. It sits exactly at the fault line of the AI power problem that everyone is experiencing right now. And I think that a lot of people are also underestimating the violent load swings that you're going to start seeing in AI data centers once inference demand balloons up. That's going to not break the grid, but somewhat show cracks on it and becomes less reliable. And I think that the zinc-based long duration storage strategy perfectly capitalizes on that problem. And also it's an American-made solution. And I think that in this administration, that matters a lot. And this has been if you guys are my subscribers, my community, you guys know this was my next Rock Lab, my next IonQ prediction earlier this year. I was like, I'm building a massive position in this name. I think it's going to get re-rated because of this really interesting solution towards the AI grid problem that isn't being priced accordingly. And there's got so many tailwinds associated with it that if management delivers, this is going to be a massive re-rating. I think we saw that this summer. I went from $4 to $20 in a matter of 6 months. So 5x. Right now it's cooling off a bit, but again, this is not an earnings to earnings story. It's not a quarterly story. this is a prolonged shift on how I want to capitalize on this AI data center power issue that's going to be lasting years, maybe even for the next decade. I don't know. Like, my prediction has always been 2020, end of 2027 is when code red happens on the grid issue for AI data, the AI theme. Maybe it happens ahead of time or not. I don't know. My base case is 2027. So this really is like, it wasn't supposed to be that explosive this year, but it ended up being that. I think it's a multi-year journey for this one. So I do love this name, but it's probably has to consolidate a bit around this range. It really exploded in a short amount of time. So let's see. Next one, let's do a SaaS one. Srima Hendron. I'm so bad with names. I apologize. Yes. Will SaaS bounce back in 2026? Enterprise inertia is real. No one is ditching Salesforce anytime soon, which I absolutely agree with. I think that whole Salesforce will be here. I don't care whoever says they won't be here. They don't really know the space. They will be here. But AI layered into SaaS still feels like a strong and natural next phase. I completely agree that SaaS, there's going to be a handful of SaaS winners in the space. And I think that's the spotlight for SaaS keeps getting pushed and pushed. So I thought it might be a 2025 thing. I think it's actually going to be a 2027 thing. And I think the reason for that is because, again, have heard me talk for years now. Like, the AI tsunami, I've always predicted is going to destroy SaaS. And I think it's going to be at a level that is under discussed and undercovered, because there are so many SaaS companies that are horizontal SaaS. And what I mean by that is they're a feature in someone else's stack. They're not really a data infrastructure play. And a lot of SaaS, they look great fundamentally because it's extremely difficult to grow. It's extremely difficult to have 80% gross margins. It's not an easy feat at all. Like, it's very difficult to qualify for Rule 40 scores. Every CEO's terminal dream if you're starting a company. And a lot of SaaS companies are qualifying for that. But because that AI tsunami is coming from the SaaS space, and it's so obvious that it is, that this theme is kind of stuck in mud a bit, because although their earnings continue, like, their fundamentals aren't getting impacted from the AI tsunami, their multiples are. So, and a great example is ServiceNow. I think ServiceNow is on my watch list for my fourth industrial revolution portfolio. Like, I think they're a blue chip, large cap SaaS company that is just beautifully run, and they're positioned perfectly on enterprise IT. They are trading at 32 times free cash flow, even after this pullback they've experienced this year. I think what we're seeing in the SaaS space is a lot of companies who are trading at 40 to 50 times free cash flow that are Gen AI vulnerable are getting re-rated to 30 times and below. And that re-rating is factoring the risks now assigned to SaaS in general. And doesn't mean it's going to be dead, but the multiple that the market's willing to pay up for the space has changed. And that is the new reality. If you don't believe in that reality, then maybe this is the opportunity to buy into this space. But for me, I absolutely believe that is the reality. And it's a fair reality, because a lot of it is horizontal SaaS. I think 95% of SaaS companies are horizontal SaaS or just a feature. I think the CRM space specifically, that is a feature. But doesn't mean that there won't be 2 or 3 CRM names out there. Like, I think that there is going to be, I think Salesforce will be the large enterprise. They're going to own the large enterprise space for CRMs. I don't think they're going anywhere. But I think that the second place, whoever gets the mid-markets, will do fine. Like, that's between HubSpot and Monday.com is fighting out for that spot. But the rest of the space is just like, I think they're going to get acquired. There's going to be acquired for that feature into someone else's ecosystem. And it might be dead money until that occurs. ServiceNow, they're turning into a CRM company in a way. I think the acquisition that they made for that cybersecurity company, that was for $8 billion. Like, that was their way of kind of becoming this operating system for not just IT workflow, but for on devices. And I think that they're realizing like they have to be much more than what they currently are. And in order to do that, you kind of need to acquire all these BI tools to sell this platform narrative. The issue with that, though, is dilution. The issue with that is margin compression. The issue with that is land and expand model where you have to acquire your way to grow or acquire your way to become bigger than what you are. And that's going to create this opportunity cost for a lot of shareholders that you don't really want to participate in if you're in this, when we have multiple super cycles occurring at the same time. So I think you're going to start seeing software kind of be dead money still. And I think that 2027 is really where I'm underwriting the base case. So maybe finally they have their spotlight. But even then, I don't know. Like it's these ecosystems are becoming much more of a walled garden. I own two names, and I think that's two names in the space, Snowflake and MongoDB. They're very much a data infrastructure angle, and they're not really SaaS, in my opinion. They are, but they're not really, and they have a consumption model. So I think a lot of these SaaS companies do have to convert to consumption model from seat-based licensing model. That takes time. It's not a flip of a switch. You have to get completely different sales teams in order to fulfill that pivot. And you saw it with GitLab, I think a year or two ago, where they tried to make that pivot because they saw like this is in a AI economy is consumption based. So we have to get ahead of it. And GitLab's another good example of like, I don't know, like they have a duopoly in what they do with GitHub. But Microsoft, like the Microsoft ecosystem, like how can they compete with that? Like Microsoft owns the enterprise space. So it's like GitHub is just becomes this connectivity tissue in their whole ecosystem that they can just like operate GitHub at a negative margin if they wanted to, because they can make it up for it elsewhere in the ecosystem, where GitLab, like they can't operate at a negative margin. Like they have due diligence that they have guidance they have to maintain, and that's not just maintain, they have to expand it, because that's the expectations of being a publicly traded company. Is like not just hitting your estimates, but you have to beat it and continually to beat it every year. That's a lot of pressure. So how can they compete with a GitHub that can technically operate at negative margins? Because guess what? Like Microsoft doesn't have to communicate what the margins are for GitHub. It's such a massive enterprise ecosystem. That's an example of what I'm referencing of like SaaS is difficult. Nobody wants to live on SaaS Avenue. Everyone's trying to move out. And in order to move out, you don't have to just convince the market that you're going to survive, but you have to convince that you're going to thrive. And that's going to take some time. It's not going to just happen in fundamentals. It's going to happen once you have multiple gut punches that shows like, I'm still surviving and we're thriving. Like our mode is defensible. We're going to be here for a long run. That's not going to happen in months. It's going to probably happen in years. And that's why I haven't added at all Snowflake in a while. MongoDB just had an insane core. MongoDB is a perfect example of what needs to be shown in order for the market to believe that you will be an AI winner potentially, not an AI casualty from the tsunami that's coming. Cloud Atlas reaccelerated 3 straight quarters, like not just one bump, another bump, and a continuous bump. 3 straight. That shows to me specifically that AI is actually a tailwind for them. And I think that it's going to continue being a tailwind if we continue to see this momentum build and build and build. And databases is a huge market for the AI economy. The issue is it's hyper competitive. And Oracle is just the king in that space. Doesn't mean that like MongoDB won't succeed. It's just MongoDB is heavily exposed to the transactional component of AI databases. And I think a lot of AI applications would need to be created in order for them to like really catch a major bid. But you're seeing that already, because this, one of my thesis for AI was digital product explosion from AI tools. That creates a lot more AI applications, which should feed into database play like Mongo. So I think that as time goes on, you're going to see their Atlas cloud become much more of an overweight in their revenue profile, which is going to be a major tailwind for the stock. And that's kind of why you're seeing them be one of the better SaaS performers out there, is because they've proven it with a specific product that fits perfectly in AI economy, that it's accelerating at a rapid pace. Snowflake, I mean, I'm annoyed with Snowflake. I'm not gonna lie. It's just because it's not Snowflake specifically, management specifically. It's just like I'm a Databricks share. I participated in Databricks private round a year ago or so. I talk to people in that space because I have friends in enterprise AI that high up that kind of I live in LA and there's a lot of people in that space and I interact with them a lot. And Databricks is underpricing Snowflake at almost every single meeting. And I think that there's only so much that Snowflake can do in order to offset that because the pressures of being a publicly traded company is you have to fit a specific margin profile. And if you don't, you have a reckoning you have to pay and you have to communicate and it just becomes such a headache. So Databricks, for example, they were at 77% gross margins last year. They're at 74% this year. They're not experiencing a margin expansion opportunity from AI because they have to underprice what Snowflake's offering in order to win those customer deals. I do believe Databricks is the superior play on data intelligence or data lakes, data warehouse, whatever you want to call it, than Snowflake because they were created with that AI lens where Snowflake had to become a data warehouse into something else. And that does take time and also makes it a little messy, but Databricks had a leg up on Snowflake always because they started with that AI lens. But they're just underpricing Snowflake, and Snowflake, there's nothing they could do about it until I don't know, Databricks goes public, and they actually have to have same apples to apples that what Snowflake has to offer. Deal with. So I think Snowflake is just experiencing a Databricks issue, and like they can't compete on pricing without sacrificing margins. And Databricks is just just is really just hurting their growth story a bit. And I think that Snowflake caught a major bid entering their recent print. And a lot of people anticipate, because for the first time in 3 years, their net retention revenue actually increased 2 quarters ago for the first time in 3 years. So people that was like, oh, this is just like MongoDB. Like they're seeing an actual AI tailwind acceleration on NRR. So then it was at 125. I remember this. I think it went from 123 to 125%. So the anticipation with this recent earnings print was it should continue. We just saw Atlas, the data cloud for MongoDB, continue that reacceleration. Snowflake should see something similar. So maybe 126, 127. It stayed flat at 125. That, to me, I think was the biggest driver of that pullback we've seen in Snowflake stock was that acceleration just a one-off for some odd reason or not like a permanent trend? I'm hoping it is not the latter. I hope it is just like a Databricks issue, or maybe it's just like we're going to continue to see a acceleration, or maybe 125 is just their base case. And if that's the case, that's totally fine. But the stock has ran up into that print with anticipation that it was going to reaccelerate. It didn't happen. So it pulled back, and now what's Snowflake trading at right now? So we just got ServiceNow is trading at 33 times free cash flow. Snowflake's trading at 55 times. Different businesses. One's consumption. One is got a consumption lens with Raptor, but it's really a seat-based model. Different profiles, but like you can see the price difference on the premium valuation on Snowflake. So it needed to kind of pull back because it didn't prove any reacceleration story that we had from Mongo. I think it will come. I really do believe so, but there's risk, and I'm not going to be adding until I see further signs of the reacceleration or some more AI tailwind. I am way over, guys. This was fun. I do think that 2026 is going to be a year where I gave myself a goal of I want to be more, I guess, I don't know, calling it streaming is weird, but like, I want to be more like office hours. So just call it that. So I think maybe we do more sessions like this where it's just like Shai's office hours, or we do more interactions. I love the Q&A. So maybe we give more time for the Q&As on the Futurum Equities podcast, but the issue is scheduling. Scheduling is difficult. There's not enough time in the day. I wish there was, but again, hopefully you guys have a great holidays. Like we're not going to be doing an episode next week. The next episode will be the first one of 2026. We did 25 episodes of the Futurum Equities podcast. I hope you guys enjoyed it as much as we did. I do want this to be more interactive. Daniel and I only know so much. If you guys want something more that we aren't offering, please comment below. Let us know. I think it's fun talking with you guys. It makes me feel like we're just like, I've always wanted to say, hey, Chad, let me know like this. So this is pretty cool. Like, so I do like interacting with you guys a lot more. So let us know what we can do going forward. If you guys want more Q&A time, or you just want just more of Daniel and I talking about what's happening in the market, whatever it may be, just be openly commenting what you guys would expect from us. So thanks for tuning in. This is episode 25. Hope you and your loved ones have happy holidays. Remember, the reason you guys are here is to empower yourselves to have that financial independence and freedom for your loved ones. So like, this is the reason we're here. This is why we play the game. Is we're participating in the greatest game in the world, in the stock markets, to gain the knowledge in order to better ourselves and our family and our loved ones. So this is a perfect time to appreciate that, self-reflect on that, and enjoy the rest, because 2026 will be a volatile one. So midterm election creates volatility. There's a lot of bear narratives on AI data centers that's still going to be present. Space and quantum are getting ahead of themselves. Nuclear is still getting ahead of itself, but like still bullish themes. There's going to be a lot of congestion. Let's just say that. So enjoy the rest, because it will be a volatile year in my opinion. So see you guys in 2 weeks, and enjoy the holidays.